Hey trader, Steven here. It is Thursday, May the 2nd. I didn't do a market webinar last week, so we got a lot to cover today. Going to look at the market and kind of how that's doing and maybe what to expect here in the short term and also what I think is going to happen in the long term. So, the market sure has came a long way off the bottom. Came all the way back. We're at an all-time high. So we have a lot to discuss today, so I really just want to hop right into it. The S&P 500, I was talking about for a while that I think that the market, even when it was down here, I think the market, it seems reasonable that it's going to take out the all-time highs before we get something meaningful or a pullback, a correction of some sort. So, right now, I think right here, actually I want to do one thing. What I wanted to do is I wanted to throw this purple line, and that's the 5-day moving average. And really the market has, let's just look at the S&P and then we're going to look at the Nasdaq, has ridden this 5-day moving average for a month. I mean, we're going back to, for the whole month of April, I don't really see, maybe right here it closed below it. But absolutely held that 5-day moving average really until yesterday when we had a reversal day in the overall market in the Nasdaq 2 days after the S&P 500 closed at an all-time high. So this is really, really strong price action. It seems very reasonable that, now that we've kind of ran a lot of stops up here, we could get a pullback. But keep in mind that, the market is still strong. It's continuing to go, but yesterday's price action was something I think to be cautious of. I'm trying not to find little nitpick things to say, oh, well, the market's going to pull back here, because the market's still strong, and I think you need to try to stay with your positions as long as you can, or at least have a plan in case they start to pull back, or a buy plan in case the market pulls back, so you can kind of load up a little bit. But, we've had a couple pullbacks. I always use the rule of 3 when it comes to pullbacks and consolidations. You have a couple pullbacks. Sometimes the third one out is usually when the market's tired. It doesn't always work as smoothly as the first two, so it could be, more of a longer consolidation. But the S&P 100% picked off this high, and then a couple days later it started to reverse. So I would just be incredibly cautious. I know that fear of missing out is really getting to people right now, and I want to talk a little bit more about that as I move over to the Nasdaq chart right here. So we're looking at the Nasdaq. One reason I'm looking at this is because the Nasdaq is a little bit stronger than the S&P 500, as it usually is. The tech stocks have been dominating, but you can see, if I draw this inspect button right here, the Nasdaq had a few days where it closed above the all-time high, and then it has pulled back the last 2 days in a row. So it has absolutely shot up. I read an article. I've been talking about, running these stops and then pulling back, but I also read an article yesterday that I also think made a lot of sense. So when you're looking at the overall market and you're looking at the price action, you always want to say, okay, where could it potentially get me, or where could it throw me off a little bit? And I read this article where they were talking about a melt-up yesterday, and it's going with the theme of the fear of missing out. And what a melt-up is, basically, is a melt-up is this last hoorah move when everyone is just so disappointed that they didn't make as much money as they thought they should. The market's going to the moon, and all the weak money starts piling in, and then you just get this melt up, this just straight up market action, and then you see what happens. So that's very possible too. We could get kind of one last pullback and just a straight up shot where everyone is just piling in that missed out. I'm getting a lot of emails right now like, what should I buy? What should I buy? So I can just tell people right now are just wishing they own more and more and more. And usually that's not the best sign, at least in the very short term. In the long term, I'm very, very bullish. But you can see right here, and what I did is a lot of times I'll pay attention to when I'm looking at a rally, when the price action goes over 5% above the 50-day moving average. I've noticed that is typically a place for a pullback, and literally it could just be a pullback, but you can see on this, if you want to call it a melt up or just this euphoric move, the market got almost 7% above the 50-day moving average. That is incredibly extended. So the market way overshot this. So the 5% isn't a hard rule, but I think it's something to pay attention to when you're looking at putting some money to work. Just saying, you know what, maybe if it's 5 to 6% above the 50-day moving average, historically, if you make 100 trades at that level, I think you will lose many more than you'll win, because historically you're just buying a little bit extended, or it could be a lot extended. So you make 100 trades, I think you're going to lose on 70 of them if you're buying that far off that level. So it doesn't mean you can't hit some big winners, but then you can see right here, it just waterfall effect, came back, bounced 5.5% above that level. Again, it's not like it crosses 5% and the market's going to sell off, but then the market sold off. So now we're in a strong rally. And this first one, I don't put a ton of weight into it just because of this 50-day moving average curl. It needed time to catch up to the rally. So it did get a little high, but you can see that it pulled back. And then right here, the next pullback got 6% above the 50-day moving average and pulled back. And in this most recent one, we got over 5%, 5.3% as the market's breaking to an all-time high. And the last couple days, the market has struggled. So I think this is sometimes a good guide when, if you're not sure, what the market is doing or where it is, or if it's a good place to buy or if it's a good place for a pullback, sometimes you can just, make this stretch and say, okay, where is the market relative to the 50-day moving average? This is an incredibly simple tool to help identify if it's potentially extended or not. And so I use it all the time, and I'm like, historically not the best time to buy. And again, you want to be the house, right? It's just like a casino. You want to do all these little things to put the odds in your favor. And even if you do all these little things, you still only could win 65, 70% of the time. But if you're losing a lot less than you're making, then you're going to make a lot of money. So just something to absolutely consider right here. We'll see what the market does. I think it just seems likely that we're going to get a pause or a pullback. But now these pullbacks right here, this was 4%, this was 3%. They were nothing. So I think if you do get a pullback, if you get a 3-4% pullback, I think you got to test the waters a little bit. Put at least one position to work, and if it doesn't, and the market wants to take a little deeper pullback, then you can make your decision at that time. Give it a little bit more time. That's okay. Hopefully you made some money on this ride. You can lose one or two. Because typically a lot of times the hardest time is at the bottom and is at the very top. And especially when it gets close to the very top, you start to see the price action in the individual stocks falter before it does the overall market. I've shown this chart before. This is a zigzag chart, and I just want to show you that every zigzag line is at least a 10% move. So just want to show you how many 10% moves we've had in the last year and a half or so, really since the beginning of early 2018. So we've had quite a few, but the market is still at an all-time high. So I think it's just important to know volatility. You should always expect volatility, right? And just have a simple plan in place. But a lot of times after a lot of zigzags comes big trends. And that's the point I'm trying to make. Then you have 5, 6, 7 zigzags, big trend. And this is the bottom of 09, ton of zigzags. And then you had a nice trend, correction, nice trend, correction, big trend, big trend. So that's just really the point I'm trying to make is to, no matter what the market does right here, if it pulls back, if it goes up 5%, if it pulls back 3%, 10, goes all the way back down and tests the double bottom, no matter what, still think it's important to notice that out of huge volatility times comes absolutely big trends. And I want to kind of reiterate this S&P 500 S&P 500 100-year chart that goes all the way back to 22 that just shows you the super cycles that we've had, where you have anywhere from 10 to 20 years of the market has gone nowhere, and then you have 20 years of 15 to 20% averages, and then you have 10 to 20 years of the market's gone nowhere, like from 2000 2013. And then it breaks out of its box. So if history is a guide, we have to be slightly, we could be anywhere, you know, in this line, but I think it's going to pay to think that we're somewhere in the middle, maybe even slightly over half, because you can see even bear markets, there were a lot of bear markets. There were 3, I think, from 87 to 2000, 3 or 4 bear markets, but you had this secular bull market. So I just kind of wanted to show you this again, and show you that the market, it can really make major runs after these little blips on the screen. They look like blips on the screen. They're not in real time, but this right here was a bear market. I think right here in 98 came right back and just absolutely went on a tear. So if I'm going to nitpick and I'm going to look at the little things, I want to look at the breadth for a second. Let's look at the short-term breadth. So the short-term breadth, you can see right here, this is the percent of stocks above the, in the S&P 500, above the 20-day moving average. This peaked April 5th. This peaked a month ago and is slowly coming down. Now, before you say the sky is falling, a lot of times it is sector rotation. I've seen this before where you have what looks like is going to be a big pullback, and literally just the sectors that have been the strongest on the most recent uptrend, you know, they start to sell off, and it just takes a little bit of time for this breadth to work itself out, for these sectors to rotate, and then money starts piling into different sectors for the next leg. But really, you have in the last month that breadth in the short term has been weakening. It hasn't fallen off a cliff, but it has been weakening, so it's something to be aware of. Now, technology has really been the strongest out of all the industries, out of all the sectors, but as of lately, it looks like when you see this, when technology is closing at an all-time high, and then the breadth is peaked a month ago or peaked a couple weeks ago, really what that means is fewer stocks are pushing up the market. It's not always a good sign. Maybe it just means we need a little pullback. This was a pullback, this was a pullback, and it wasn't really that bad. So technology is weakening. Financials right now are the standout to me, because even though, yes, they're curling a little bit for the most part, this is a very short-term indicator, so there's going to be a lot of whipsaws. But for the most part, the way I see it is financials, they were weak a lot last year. And they were weak a little bit right here, just really sold off, and now it looks like to me they're one of the strongest. So we're going to continue to keep an eye on that, maybe do some fishing, look at some individual industries within the financial sector. But then you had discretionary stocks, which you don't want to see that really get weak, but it's been getting weak. So a lot of times when I talk about, hey, the market's going higher, but I'm not seeing a ton of stocks that I really like and they're not really working very well, this is what I mean. You can see some of the more aggressive stocks, they start to base or consolidate or pull back before the market does. Industrials are still strong, but again, you see that breadth. Healthcare has absolutely just gone out of favor. You know, it just really sold off. Maybe it was the universal healthcare talk. But they have really sold off, so I'm interested to see if money starts to pile into them again. Staples, I would say, are still strong for the most part relative to some of the other industries, which is not always the best sign, but I wouldn't say that's a big deal. Energy is the weakest, which is interesting because oil hasn't really had a meaningful pullback. And this, a lot of times, you might have seen some charts in the past, like, you want the stocks to outperform the commodity they track. If the stocks are underperforming the commodity they track, I think the rally is very suspect. So I'm really not that interested in this right now because there's not broad participation. Materials have gotten weak and utilities are strong. So, you know, I don't want anything to do with utilities or staples. I mean, if the weak stocks or the more defensive stocks are not doing that well, I'd probably just rather be in cash and wait for a more aggressive industry to come and take leadership. Now, the long-term breadth is still bullish. We still have 3% of stocks in the S&P above their 200-day moving average. Market's at an all-time high. We got our golden cross a few weeks ago. It's hard to make a bearish case for the market. You know, the VIX is low, even though it's popped a little bit the last week. It's hard to make a bearish case that this is going to come all the way back down here. I think you're going to lose money if you try to play that game. I can make a pullback case, but I can't really make a bearish case right now. So the percent of stocks above the 50-day moving average also peaked about a month ago, but still 70%, anything above 60% is considered bullish. 70% is a really, really strong trend. So in the long term, stocks are still in good shape. They might just look like in the very short term they need a pause or a breather. So we'll just continue to keep our eye on that. If we look at, so this is the S&P 500 versus the international stocks, the All World X US ETF, the VEU. And you can see right here, a lot of times you get asked, like, you know, where should I put money? You know, where is the strongest? And it's actually pretty simple when you look at things. You want to focus on, at this point, what has already hit an all-time high. If you're focusing on the laggards, you're going to get lagging performance. Technology, you know, a lot of other industries, financials are starting to lead a little bit, so I'm paying attention to those. You want to pay attention to what is leading. So you can see right here that what's interesting is if we're looking at the purple line, the international stocks, they never bounced. When they peaked, they were outperforming, but when they peaked in early 2018, you can see the S&P 500 came back to an all-time high. This just rolled over. And sometimes, you know, you can look at that as a negative divergence right there. But it's also kind of interesting how much weaker international stocks are, because you have this rally and it has not even close made up to what the S&P 500 is. So, you know, international stocks versus US, I would definitely make the case for US. I don't really see, I don't know why you would want to be in the laggard right now. So it's just important to look at these relative charts and see which one's the leader, which one's the laggard. If we look at bonds, bonds are still, this is the TLT, bonds are still producing higher lows. So you have right here, the TLT broke out of a 2-year trend line. It bottomed. It's interesting how bonds always peak before stocks and then they bottom before stocks. But bonds bottomed before stocks, came out, tested it, surged to a new high, looking like it's testing again. So, you know, that's not a good sign for treasury yields. So always keep an eye on that. But right now bonds they're not going to be up as much as stocks. But, you know, yesterday they were up when the markets, you know, pulled back. So this is just kind of goes to show you, I think right now that bonds being negatively correlated with treasury yields. I mean, you have to look at this as a positive for bonds being where yields, and utilities are correlated with the TLT. So what that means is if the TLT or bonds are going up, a lot of times that means utilities or high dividend paying stocks are going to move up with it, because people would rather, you know, buy the higher yielding stuff. They look more attractive. And then you have REITs as well. REITs are highly correlated to bonds. And I put down here telecom. Telecom, even though just because it is a dividend paying sector, it's not necessarily correlated with the TLT or bonds. It kind of has a mind of its own. So I think that, you know, if you're looking for the better correlations between bonds, I think utilities and REITs are the way to go. So what that means is typically when yields fall, these are going to do better, which they have done better as of recently because yields have been weak this year. So speaking, we'll just go look at that chart really quick. If you look at the 10-year treasury yield, man, I mean, this goes all the way back to 75, peaked in 81. You thought you had a double breakout right here, horizontal, head and shoulders, 30-year trend line, and it just absolutely pulled over and, you know, really rolled over right here. So this is a very, very long pattern. This goes all the way back to 2011, so we're looking 8-9 years. But yields right now, that doesn't mean, a lot of times this is what happens when you have just that definitive breakout at the obvious place. Like this is where it sucks everybody in, and it'll do one kind of just major leg, kind of run all the stops, it'll cock back, and then I think it could come out of here, which I still think it can, but this is a very, very long-term chart, so don't be sitting by the computer waiting on this to happen, because you'll be waiting for a while. If we look at the dollar, I think the dollar, it always impresses me with the dollar, because every time I think that it is going to roll over, it just continues its uptrend. So, you know, the dollar, actually I want to go back, I want to look at a 3-year chart, see if that will give me a bigger picture. So you can see right here, the dollar was very strong in 2016, and then really from 2017 to early 2018, just very weak, right? Big sell-off. The dollar was in a bear market, and now it broke out. It's making higher highs. It's coming back, right? So this is negative for international stocks because typically they have a negative correlation. So it's just, this also is negative for gold, right? So typically when the stronger the dollar, the weaker commodities, which gold's been looking pretty weak. So I thought this thing was going to roll over several times, but the dollar just keeps getting stronger. It keeps getting stronger. So it's in an uptrend, and until we absolutely roll over, I think you have to respect that uptrend. So if we look at the dollar correlation, this is the US dollar just on a different chart, but you can see this is a correlation box. And if it's below the zero line, it is negatively correlated. You can see international stocks, the dollar is negatively correlated. So when the dollar goes up, it typically means international stocks are going to underperform or go down. So as of lately, they've been positively correlated because you can see across this line. But for the most part, really over the last 10 years, you can see clear as day, most of the price action is under this, meaning when the dollar is going up, international stocks are not doing very well. Same thing with gold. You can see there have been some positive spikes. Obviously, they can decouple from each other, but for the most part, when the dollar goes up or when the dollar goes down, they're just going to be inversely correlated. So based on where the dollar's at, I think you need to continue to try to focus on U.S.-based stocks, or at least, stocks listed on the U.S. exchange. Not try to get too fancy with international stocks at the moment, because I think you'd be fighting the trend. So if we look at the sector summary, I want to go back 1 week. There's been some buying off the bottom in healthcare, but financials are up there, REITs are up there, utilities are up there. It's not really the best group. I don't really like seeing this, but it could just have to do with money could be rotating into these, but it also could have to do with the yields. So energy is not doing well. You can see commodity related stuff is not doing well because we just looked at the dollar and the dollar is strong. But also in the last week, our 3 more aggressive sectors, technology, industrial, and consumer discretionary, haven't done as well. 1 week is not a trend. Let's just kind of go back and look at 1 month. The financial sector is looking interesting, so I want to dive into that here in a second to see, is it the insurance brokers, is it the banks, is it the bank, the Goldman Sachs of the world, so we can look at that. But you can see in the last 1 month, technology's up here, financials up here, and if we rank this by scooter, and the scooter ranking is really a 12-month relative strength rating, you can see financials are in the middle of the pack. And then all of a sudden, in the last 1 month, if I change over to the price, you can see that, if I go from the 12-month ranking to the 1 month ranking, financials are starting to lead. So, I talk about that sector rotation a little bit. The market it broke out to an all-time high. So once we get to the all-time high, we could absolutely have a pretty nice consolidation, pullback, correction, whatever. But money, the big money could start to flow into different sectors. So I am really, really paying attention to this financial sector. So let's really look at, when you look at the financial sector, right? And then you have all these industries, right? So you want to pick the strongest stocks and the strongest industries and the strongest sectors. So looking at here, the first thing I want to see when I'm looking at a sector is I want to look at all the industries, and is there broad participation within that industry? And the answer is yes. I mean, look at all the green right here. And it's funny if you just say, okay, the financial sector is doing good, I'm going to go out there and buy insurance brokers. I mean, that's negative. So that's why a lot of times, I think sometimes like an XLF, if you want to be conservative, you can buy a bigger sector ETF, but a lot of times you want to dive deep a little bit and say, okay, you know, there is a 7% difference between buying a mortgage finance ETF versus a insurance broker ETF. That's a big difference. So you want to really pay attention, but let's kind of look at the mortgage finance a little bit. And let's see what is showing. See, there's a lot of strength in here, a lot of buying, mostly green, a little bit of red, but I would definitely consider that broad participation. You got some preferred stocks. I don't really want anything to do with that. Walter Dunlap. Let's look at this chart. Man, this gapped up yesterday. Boy, that's a strong, strong chart. Look at that. From 37 to 58. Pretty deep pullback, and you could call this a cup with handle, and just absolutely just kind of a wild day yesterday. If this could pull back into kind of back to this pivot zone, I think right now it's extended, but that might not be a bad stock to put on your watch list. Walter Dunlap is one of the strongest stocks and one of the strongest industries and one of the strongest sectors. Let's look at this Radian for a second. That's how you pronounce it. Yeah, this stock is gone. I mean, I don't see, if you want to buy a pullback, I don't see anywhere. You know, it's had one consolidation and then it just went up. Lots of accumulation stepping in lately, but I don't see that anywhere near a buy area. I'm just kind of looking. Lending Tree, I know this stock has been a leader, so let's look at this. Yeah, again, I kind of want to look at the longer term chart, but Lending Tree right here, it hasn't even really consolidated. So, you know, you have it from $200 to $400. It doubled this year. That's a pretty impressive move. You know, that's a 4 to 5-fold multiplier of the market. So, and it hasn't even consolidated once. To me, what this is telling me is if you have something that's doubled and gone up, you know, multiply the market 4 to 5 times, and it really hasn't even consolidated, I think this is an industry or sector you need to look at for potentially very, very long term, because a lot of these stocks haven't even consolidated yet. This is not near a buy area in my opinion. I think it needs to consolidate for a little bit, let a pattern emerge. So I'm not telling you to go out and buy this, but something interesting to continue to put on your watch list. Let's look at Essent. Yeah, again, you know, this has moved higher, but this is more of choppy price action. This is something I would avoid just because I like nice and smooth. Now, this is nice and smooth, but then it just gets really sloppy. And you talk about, always look for personality changes in stocks, right? And it's clear to me that if when it went up, this was nice and neat, and you don't expect that to go up forever, but you want a nicer and neat, at least a nice and neat consolidation, and that just didn't happen. Now it's getting sloppy. Indecision is coming into the stock. I would avoid this completely. So let's go, kind of take a step back. Let's look at the banks for a minute. Let me just kind of close out all these, and let's look at banks. Okay, so, man, these look, yeah, there's a ton of banks, but obviously, I would say there's a lot more green right here than red. But, I mean, you can easily just look at this, and this is a South American bank. Let's just look at it for a second. I bet it's long gone. Too thin. I guess I could have looked at the volume, but let's look at this bank. I don't, ENFC. Bought out, so yeah, Meta Financial, just going down the list. Boy, that looks like a volatile one, but it went from 17 to 26 in about a month. So the way I see it, I would identify that as a fast-moving stock, and I like fast movers, especially where we're at in the market right now, but this is extended. So a lot of times what happens, and this is kind of a good lesson, you know, when a stock is living below the 200-day moving average, so looking at a potential entry, and when it breaks above it, I think this is the worst place to buy it, even though it broke this consolidation, just because it already moved so much to kind of break through two zones, and you can see all the volume that it needed. And this might be in earnings, I don't know. But a lot of times when it breaks above the long-term moving average for the first time in a while, what it's going to do is it's going to come back, it's going to pull back, and it's going to find support at one of these moving average. And typically it might put in a hammer or reversal bar. Not all the time, but if it pulls back and you see a hammer right at this 20-day moving average, which is under the 200-day moving average, that is an excellent entry with a stop under that hammer, because it's going to, again, a lot of people bought right here, as you can see with the volume. It needs to shake those people out, go under this candle, but find support right under it, just tick everybody off, and then there's your entry right there. So you want to look at it as like buying the shakeout, instead of trying to buy the breakout. I think over time that you're going to do a lot better with that. So that's really all I have for today. I think I covered absolutely everything I wanted to cover. I think it's just very important to be patient. If I could teach you anything right now, is be patient. The market just broke to an all-time high, but you know, if we go back to the price action, the market's 5% or was 5% above the 50-day moving average. I think over 100 trades, I think 70 times, 60, 70 times, you'll probably lose money if you're buying right there, unless you're just really, really buying those fast moving stocks, the kind that can buck the trend. So just kind of keep that in mind. I think letting the market come to you and being patient right now is probably a wise idea.